Paul asked our first question via email, and his question is related to adjusting a collar position. And his question was, he said, I watched your YouTube video Waiting to Roll from back in 2010. This was about rolling covered calls, which I also tend to look at for the same sort of concepts for rolling a collar spread based on the short call movement. But of course, there's other things you can do because the collar has two working options, not just one. All right. But attached are two of his current positions in the email. We have a collar on XLU. The call is slightly in the money. Anytime you're tracking a position in our portfolio, you can link to the position analysis screen to see potential rollout opportunities. Right now, there's a reason that XLU does not show a potential rollout. We'll take a look at that in just one moment. And the CLF position, his call is out of the money, and the position analysis recommends rolling the put. Well, it shows an opportunity to roll the put further out in time, which is strange, but it's there for a reason. So he says, are you correct in assuming that you would do nothing with the call? I might be called away or might have an opportunity to write a new call when the current call expires. Okay, well, let's take a look at that and others. Now, first, I want to be clear. Talking about the different names for different structures, when I say collar, a collar by definition is any combination of stock, call, and a put. A long collar means I'm buying the stock, selling an at or out of the money call against it, and buying a put option. Now, they can be different time frames. I can buy a put 6 months out in time and sell a 1 week out call. Or I can buy a put that's 4 months out in time and sell a call that's 1 month out in time. Or you can do it with different structures, of course, as well. Now, when I say collar, I typically mean a 1 week to 1 month trade where I'm buying stock, I'm buying an out of the money put below the stock price for a reasonable small premium, but still enough protection, and I'm selling an at or just out of the money call with the same expiration date. The structure is much safer than a covered call, though the max return is going to be lower. In my collar approach, and it doesn't have to be everyone's, but mine is, when I enter the collar and the stock is above the strike price, I'll allow the collar to be assigned and move on. That's what I wanted to accomplish. I'm not going to worry about consistently rolling and adjusting it, and I'll talk about why in a moment. If the stock is between the strike prices at expiration or close to it, I may manage the position and simply re-bracket the collar going further out in time or for the same expiration dates, depending on the structure. And if the stock falls below the put strike price, I may just exit the position for the maximum loss and move on. Pretty simple. But here is a collar on PHM, the Polte Group. If I was to open a collar today, I'd buy stock around $30.47. I might go 2 weeks out to June 8th expiration, 14 days out in time. With a stock at $30.47, I might sell the 31 call, and I might buy the 29 put. Now, this isn't a lot of premium. I'd probably go further out to get better premiums here. But in this case, you see the risk-reward profile. And this is standard of what my collar structures that I trade with about 15 to 20% of my portfolio are. I'm looking for a 2 week out return of about 2 to 2.1% or higher, and I don't want to usually take a risk of higher than 5%. With that trading plan, I do need to be right about 67 to 69% of the time to profit long term. Okay. Now, again, if the stock is above, let me get a good pen color here. If the stock is above my short call strike price at any time, I'm not worried about rolling this particular collar for more profit. I traded this because this is the return that I was hoping for in that 14-day period. So my approach is different than yours, Paul. I might not even consider rolling this if it's in the money. I'm looking to be assigned, take the profit, and get out of the position. If Potle stays here around this 30.50 mark through the 8th of June, well, on the 8th of June, I might buy to close this short call and sell to close or let that put expire, naturally just do nothing with it, and then re-bracket the collar. I might sell a 22nd of June 31 call and buy a 22nd of June 29. If the stock's down in this range or it fell below the put strike price, I may just close it out for the loss, rather than trying to maneuver a position that's not going in the right direction and continue to trade it. As long as I'm still able to keep that 67 to 69% profit range while taking losses occasionally, I'm doing this as more of a fire and forget trade. My goal is to be assigned. And if the stock's not performing the way I want, I'm okay taking this maximum risk because it matched in my trading plan. Naturally, we'd never prefer to take a loss, but I'm not going to try to manage a position that's not going in the right direction on a neutral to bullish strategy and keep managing it and risk taking farther losses, higher losses, I should say. So that's my basic and general approach to the collars. Now, that being said, many of you know I also advocate and I do trade the radioactive trading techniques with a married put. The put's usually out 6 to 8 months out in time. I'm usually taking a risk of about 5%. A radioactive married put may become a type of collar if I use income method number 1, selling the call against it to create the collar. But the call is sold shorter term. I might only have 1 month out or less on the call I sell against the married put, while the put still might be 3 to 8 months to go. This is more like a calendar collar spread because there's different times. And with a married put, I am looking for that longer term growth, Paul. Why am I bringing this up? Because with a married put, if I think something is going to be strong to bullish over the next 5 or 6 months, I'm trading it as a married put. I may sell a call later, but that might actually hinder my upside growth if I'm correct in the direction of the stock. Never sell a call right away. Wait for the stock to move up and look for a good opportunity. With a collar, I'm looking for the quick return with protection. It's not something I'm considering just to keep rolling and rolling for 1 to 2 to 3 months out in time. I'm really looking for just that first right cycle to get the profit, manage it to where it's only a little bit loss or more. Okay. Okay, I'm just scrolling through some of the questions here to make sure I've got. Okay, good. All right, so this would be a standard married put. Now, 40 days ago, this is the position I'm actually in. I bought PHM at 30.02, bought the October 31 put for $3. Risk of 6.1%, which only occurs at October expiration. Now, the stock has been up 5%, and it's been down 4%. It dropped down to about 29.30, okay? I could create, it's only up about 2.4% now. I could create a collar position by selling that same 31 call we were looking at for 35 cents, but this doesn't put me in any desirable structure. Even though the stock is up, even though it's near my put strike price, going out to June, 14 days, or even out 30 days, doesn't really give me a good structure. Reduces the risk by only 1%, doesn't put me in a profitability range. I'm very happy with a very small window to the upper and lower break even. Okay. Now, I would not do this, so why am I bringing it up? Again, I'm bringing it up to illustrate that if I'm planning on something to be bullish long term, I'm trading it as a married put, and I'll use the 12 different income methods talked about in the blueprint to manage the position. But when I go into a standard collar, I expect to be assigned, and I don't plan on extending the trade beyond that initial 14, 21, or maybe 1 month out in time. If it's below the put, I might manage it, but I'm more likely just to take the loss because I was comfortable with taking the loss for my trading plan to begin with. If between, I might recollar the position. Now, with income method number 1 on the married put, if the stock moves up, I am going to have to adjust that call because my plan is to stay in the position longer term. With the standard collar, I'm not. But let's get away from all that and let's actually talk about your positions, which is why you asked the question, Paul. I just wanted to state that because so you have an idea of what I look for in my collars when I go forward. Your CLF position, based on the numbers you gave me, your current loss is about 4.7% with a maximum loss at 7.3%. So if you bought to close the call, sold to close the put, and sold to close the stock at 8.20, where it was when I did this around 3:15, 3:30 today. I'm sorry, the current loss is 4.7%. Your liquidation was around 5.3%, I believe, on the position. Now, that's assuming the stock stays at the same price to June 8th. Of course, we know it's going to fluctuate. Now, the rollout opportunities in the portfolio, as I'm tracking the position, I go to position actions and position analysis. The rollout opportunities show rolling this put out to October. Why? Well, it's to give you more time, because right now there are not a lot of adjustments with rebracketing that collar, moving the short call, doing those type of adjustments that would really put you in a much better situation. Now, you could liquidate it now and lower your cost basis by about 10 cents. But this October put just came up because the stock's not doing, the stock's not doing what you want it to. And at the same time, we'll take a look at it in a moment, you've only been in this position for 1 or 2 days. You've just opened the position. So we want to give it a little bit of time to come to fruition a little bit. Monday might change. That being said, we take a look at the stock chart. Why was that roll shown going out to October? It's to add time, because right now it doesn't seem like it's doing what you want. Now, I see this negative MACD crossover that happened, and the stock is kind of approaching back down to its 20-day moving average. This is how I usually set up my structure on big charts. And the last time we sort of saw this was here. When we had that MACD crossover and the stock was going to the 20-day moving average. This might have actually been an earnings event. We don't have to worry about earnings between now and expiration for your collar. I already checked that out. But, I mean, it has this tendency to come off the Bollinger Band, go below, come off, and move up, and then it looks like we might be doing it again. Now, I can't project what's going forward. You probably didn't make a trade yet, Paul, so you're going to be waiting till Monday anyway. But looking at this crossover, any adjustment you make on the collar, rolling down the call, rebracketing the collar, to make a profit, it's still going to be a bullish position. If I see this drop below the 20-day moving average and this MACD crossover extends, those are bearish indicators to me. And any management on this collar would result on the stock having to move back up in price. Okay? And I don't think I'm going to be able to do that. Yeah, I mean, I don't know if that's going to be able to happen in the next 5 to 10 days. So we might want to wait to see what happens with CLF. If you see a confirmed negative below the 20-day moving average MACD or any other indicators you use, you may just want to get out and take that 4.3% risk. Maybe it goes up to 4.5 and avoid the 7.3% risk if it continues down. Because normally in a collar, any adjustments that you make, trying to lower the collar strikes down to try to get a profit if it moves back up, you're probably going to increase the risk from 7% up to 12, 15, or 16%. For example, I ran this earlier. We might take a look at it too. Is it worth rolling? If you bought to close your call now and sold to close the put, you'd get in another 7 cents. It'd be about 9 cents for selling to close the put, and you get about 2 cents for buying to close the call. I'm sorry, yeah, 9 and 2. You took in a small credit, so you'd actually lower your cost basis to $8.52. Now, if you rolled out to the $8.50 call and bought an 8 put, it's going to be at a debit. And if you moved another week out and sold the $8.50 call and bought the 7 put, you might make a return of 1.9% if the stock's above $8.50 instead of 9 that we were at, I believe. But the risk went up to 16%. Now, you could go further out in time, but again, what is the plan on the position? When we go back, and we know that you wanted to make the max profit. Oh, I'm sorry, Paul. We wanted to make the max profit of 4.3%, but it's not doing what we want, okay? But we still have 14 days to go. You've only been in it for a day or two. Here's the other problem I see with some of this. We'll take a look at it on your next position too. You're going shorter term on these low price stocks and you're fighting nickels and dimes. All right, you from what you had entered, you sold this call at 10, you bought this at 7, so you got about 3 cents of net credit. You've only been in the trade for a couple of days, and yes, I realize it's not doing what you want. You expected it to move back up or go further. You know, it's down about 40 cents, which is significant in this situation. But rolling it now, it's still 2 weeks to go. You've only passed 1 or 2 days. One of your comments was it's expensive. Of course, my fear is you're over trading. You don't have to try to manage it every time. Yes, you want to avoid taking the max loss if possible, but rolling every time there's a little dip and then a recovery and then a little dip and a recovery, you're fighting small premiums short term. I have a feeling you're trading yourself out of these positions and not seeing the profits that you want because you're adjusting too much or fear that you have to adjust too often. Okay. I don't mean it to sound negative, Paul, but that's one of my concerns. If I'm in this position personally and I just opened this trade up, I'm waiting till at least next week to make a decision. Halfway point of the trade is 14 days to go. I'm going to stay in it. Now, if it does go below 8, I'm going to consider something and adjusting. Another important thing I need to note here is that there is some subtle flaws. We'll talk about that in a moment with the position analysis for standard collars. I'm going to look into that next week. But these are, keep in mind, the rollout opportunities that are shown, whether you're trading a covered call, a spread trade, a cash secured, naked put, any strategy you're tracking in the portfolio. These positions, these rollout opportunities are just suggestions. It really comes down to you on what makes you the most comfortable on the trade and what matches your goals. What is your plan for the position? Is it worth it to roll now to maybe lower the call down to 850 to take a risk of, or a return of 1.9% if the stock goes above 850, excuse me, and stays there instead of 9, but to take a 16% loss if it continues to move down? That's not part of your trading plan. That's double the risk you're originally taking. I don't think that fits. So it's not maybe a good idea to roll it just yet. Now let's take a look at your XLU position. According to what you showed in your what you sent me in the email, this position was open today. You bought stock at 50.15, sold 2 June 50 calls, $50.50 strike calls for June 8th, 33 cents. Bought the 49.50 for 24. This is a low risk, low return, but it's close to that 1-to-1 ratio that I know you like. And now the stock has moved up today and is trading right near your short call strike, and probably went over it, might have gone over it, excuse me, between 3 and 4 o'clock when I last looked at it. But again, your minimum net credit that you received here is 9 cents. And you said the buyback here, the buyback I looked at was 43 cents, so it's 10 cents higher here. So you're fighting nickels and dimes. Worrying about adjusting this position for a higher profit. Now, what's going to happen if you adjust the call for a higher profit? You might get a higher profit, but at the same time, you're going to increase the risk because it's going to be at a debit. You're not going to be at this close to 1-to-1 risk-reward ratio. This might go up to 1.5, and this might go up to 1.5. Now you have to ask, is that worth it to you? I didn't just grab those numbers out of a hat, by the way. That's what it would actually look like. And Sam makes a comment, and I think there's a subtle difference here. Sam made a comment that says you may want to pick stocks that have a better premium for this kind of approach, even though you're getting it every 5 to 10 days, but you're talking about a small premium. And I think Paul might actually be using more shares than I'm showing. But yes, you know, rolling those when you're only getting a small 9-cent, 10-cent credit between and paying the commissions also might not be worth it. This is not a strategy you want to trade. If I'm in this collar, I'm saying this is doing exactly what I want. I want the stock to be up in this range, and I'm not worried about higher returns on this position. Again, if I was bullish on XLU, this energy sector longer term, I would have opened it as a married put and left the upside open and not tried to get a 7, 8, 14-day 1%, 0.5% return each time. I'd rather let it grow and then adjust the position when I've met my goals. Personal preference. This is Paul's personal preference. But he asked me about rolling it, and right now this is doing exactly what I want. I wouldn't consider rolling it if you feel that you need more time. Okay, if you feel that you need more upside. I'm going to skip the trade simulator tool. We'll look at that a little bit later, but I'm going to skip that. But we're going to go to power options now real quick, and we're going to take a look at these positions. I entered them into my portfolio so we could all take a look together. And we've already talked about the CLF position. What you're looking at here, did it pop up correctly? Not yet. Oh, sorry, folks. There we go. All right, there we go. That's a little bit better. What you're looking at here, of course, is the 14-day free trial account. Those of you that are just getting started, I encourage you to follow these 4 steps. All right, so let's go to the portfolios. And this calendar spread we're going to look at in a little bit. The second question that came in via email. Let's talk about the XLU position. Open today. I'm sorry, it's 522 when Paul opened the Cleveland Cliffs position with a stock down to 823. You got 7 days to go for the June 1st series. So I'm maybe letting this go a little bit longer. You could roll down to the 850 as we talked about, but it's going to drastically lower the return. I'm not sure if it's going to match your trading goals for what you set up in that structure. That's something you have to answer for yourself. I can't do. That is a possibility. You could roll down to the June 850 from the 9. So it was cost you 2 cents to buy back here, and you could sell it for maybe 7 cents. Again, you're fighting that premium, but you took in the 8-cent profit here, got in maybe another 7 cents for the 850 for next week, but your return is going to lower. That's what's going to, it might drop to 2%, but it only has to be above 850. Let's take a look at XLU. Again, for me personally, in this situation, remember we paid 33 cents, we got 33 cents for it, selling that call, but it cost 43 cents to buy back. But this is doing exactly what I want to right now. I want this return. That's why I would have opened the trade. I want the return. I'm not going to worry about fighting for higher return because that would have been a different strategy. For me, that's why I said the Mary put. I would have done it that way if I was expecting longer term growth. Now, could we roll this up to say the 51? Well, you could, but again, we saw the effect. So I'm going to buy back the 50-50 for about 43, 44 cents, and I could sell the 51 for maybe 22. All right, so let's do 43 and 22. So I'm going to buy back the 50-50 at 43, around midpoint. I'm going to get less than midpoint here at about 22. Okay, so we're just going to roll the call up one strike and not even worry about the put at this point. Remember, the original makeup was almost a 1-to-1 risk-reward ratio. And we keep that, and that looks pretty good. Okay, so now you're at 51 strike, but now you have a lower probability of it continuing to move up in 7 days. If it stays here, if it drops, your returns here is around 15 cents or so at expiration. Okay, the risk did increase as well because of the debit. You took 33 in, paid 43 out. You do get a net credit for the call transactions, of course. You took in 55 essentially, put in 43. So now you're only getting 12 cents though, but to potentially get assigned at 51, not 50-50. That's where this increase comes from, but it also does affect the risk of buying it back. You didn't realize that full 33. In fact, you had to pay 10 cents extra on top of that. Okay. So again, could you roll this from your original position? Of course you can. But based on the premiums, based on the commission costs that would be involved, I think it's a good idea to let this go. I can't give direct trading advice, but I personally, if I'm in this trade, I'm letting it go. If it goes up to 50, 75, or maybe 51, I might consider rolling this short call at that point. But right now, I've got 7 days to go. It's doing exactly what I want. It's meeting the terms of the return that I wanted for my trading plan. If I get assigned, I'm going to let that go. Okay. And then we talked about some of the other ideas on XLF. Of course, we could. I'm sorry, CLF. Knew I was going to get those two confused. And we talked about rolling down. And of course, if you look at that scenario here for June 8th, if I buy back the 9 call right now, so let's just add that back in. Oh, am I on the wrong time period? Oh, yeah. Sorry, guys, ladies and gentlemen. Okay, so we buy that back for 2 cents. We sell the 850 for 6. And not as much as I wanted, but with these little numbers here, going forward, yeah, see, that didn't work, did it? That was the problem. It kind of worked earlier, but I think I went out. That's what it was. I liquidated this and then rolled out 2 weeks and went to the lower strike. So we effectively went to the 15th of June when I looked at that one, Paul. So it was positive being assigned. This is negative. If I rolled down, you're not getting enough premium here. So it might be better to wait to let this expire. Maybe even let that put expire at this point. You could sell to close it and get 7 cents. If you liquidated it and rolled out 2 weeks, you'd still have a profitable return. But that profitable return I saw rolling this out and restructuring it was less than half of that. It was about 2.1 to 1.9% return, depending on which prices you got at midpoint. So, but to do that again, I would have had to close this out and roll 2 weeks out. Can't roll 1 week out because you're not going to get a positive return. You can't go too far down and strike, even though the stock's at 823, because you're giving up the stock 50 cents less than, and you're not getting 50 cents net credit. That goes back to Sam's comment of the better premium and needing the better premium to make sometimes these rolls work. And Sam had mentioned that 30 to 40 cents is his minimum for a premium generation or for net premium on a collar as well. Okay, so that's just my thoughts there. But let's scroll back here to our slides very quickly, talk a little bit more about that. Now, the summary here is I'm going to look into adjusting some of the settings in the collar rolls to lean more towards these standard collars we're talking about. A lot of the adjustments you might see on the standard collars you're tracking, Paul, might be related to adding more time or adjusting the put in the form of the radioactive trading technique. That's not what you're doing, and I realize that more and more, that you're more involved, and there's nothing wrong with that because I do the standard collars too. But again, I talked about how that I want it to be assigned, and I'm not worried about extra growth even if I pick the right stock and it keeps moving up. If it's in the middle, I might rebracket the collar or just close it to get the small profit I want so I stay in the boundaries of my trading plan and the win-loss ratio I need to be successful. We're going to have some webinars over the next few weeks on standard collars, structure, management, and more. But what I suggest is make sure you sort of fine-tune your trading plan going forward. See what's not working for you, and one of the things I fear might not be working for you, in addition to the small premium, is over management of these positions. Because you're fighting nickels and dimes, and every time you have to make an adjustment, you and I talk about, whether it's on the webinar or sometimes via email, how it's costing you too much to buy back the call. The XLU position, the stock moved up 30 to 40 cents today, and it's automatically 10, 15 cents higher to buy to close that call. Well, that's what we should expect. Call's not going to decay rapidly as it's moving up. We're going to gain intrinsic and higher extrinsic value as the option goes from out of the money to at the money. Okay, and that's the trick. So it's going to cost you more to buy it back if you have to roll, unless you're closer to expiration. So my fear is that we might be trying to roll too often every time there's a movement of the stock, rather than let it play out and worry about the rolling as you get closer to expiration, or if there is a gap up and it's moved swiftly above your short call. But again, in that case, I know the buyback call for me would be too high, but I'm in the situation where I want to let it get assigned and move on. All right, question 2 via email. This one is from Khokon. I never know if I pronounced that right. Talking about HD, Home Depot. When the stock was at 191, he sold a May 18 190 call and bought a September 21 190. This is a horizontal spread. Same strike spread. I said diagonal down there. It looked to me as if Khokon was doing a horizontal same strike spread. Now, during that time, he did cash out the May 18, got a profit of $3, but he's sitting on the September 190 with the stock down to 187. And he wants to know, should he manage by converting it to a bull call? Well, 185, 190, or cash out. The chart and fundamentals are okay, but not promising. All right. Diagonal spread was my fault, not his. I went back in time using the power options tools in the historical chain, and I saw that HD was last at around 191 on May 14th. On May 13th, it jumped up about, May 11th or so. Prior to the weekend, it jumped up about 3 points, and on the 14th, it went up another 15 cents. It was trading at 191. Looking at the closing prices for the options mentioned, I could have sold the 25th of May 190 call for around 410. Bought the September 190 call for around 970. There's our horizontal same strike spread, cost basis of 560 per one contract, potential return of 248 if the stock was right at 190 on May 25th, which you see here we're below 187 as was mentioned. Now, you took the profit off the short calls, but this still kind of looks profitable for me right now. Let's go ahead and go back to where we were. Back to power options, I should say. Sorry, folks, let me just switch over here. There we go. And there we go. And the top listed calendar call spread here is what we're looking at based on what I thought the numbers might have been. How did that lower? 410 to 970, 560 to 240. Okay. I know what I did wrong. Okay, that's a little bit different there. Now it's dropped back a little bit more, and it doesn't look as profitable to me as it was earlier today when I looked at this. Okay, so now you did take $3 of profit off of this call, meaning you bought it back for 110. That 25th May call is gone. So let's clear that out. And we can lower our cost basis to $6.70 for that September 190. So now essentially, where are we? We're long call, cost of $6.70, the stock at 186. Now, You'd mentioned, should you trade it to a bull call spread? 185, 190. Well, that wouldn't be a bull call. See, you're long the 190. In order to create a bull call, you'd have to sell the 195. If you sell the 185 on this position, you're in a bear call credit spread out to September, where you feel the stock's going to be below 185. I don't think this is a good management right now. Why? Because it's 119 days away. You're going to get a great premium here if you sell the 185, but remember, this is now a bear call credit spread, not a bull spread. The bull spread would be buying the 185 and selling the 190. You already bought the 190. You're holding the 190 with a lowered cost basis of 670. Okay, so there's your bear call with the potential for a 190 profit, which is a credit you receive up front, but you have to cover the margin for the 5-point strike difference. This is a good percentage return, don't get me wrong. That's not what I'm arguing. My argument is this is 119 days out in time. A lot can happen between now and then. The stock could fall, then come back up, then move back down, then go really high for, you're going to cross at least one earnings date during this time period out to September anyway. So it could bounce all over the place during that time period. I don't like doing bear call credits or bull put credits that far out in time. Why? Because you're just setting yourself up for positions where now you're overthinking it. And number two, we want to get as much of this premium decay working in our favor as possible. But because it's out to September, until I get within those last 60 days or so to expiration, or 45 days, I don't see the rapid time decay. The time decay curve, we're 150 up here where we see some slow time decay. Then at 120, we're still seeing slow. Then about 90, it starts to kick in 20, 30 days from now. So the advantage of selling this lower strike to get the premium on the position and decay in our favor, we're not going to see that for another 60 to 70 days. And a lot can happen in 60 to 70 days. And again, remember, you could still lose now, but you lose if the stock recovers and moves back up in price. What I would suggest to you is, and again, I can make suggestions, I can't tell you what to do. My thought here, let's look at the September. Remember, you lowered your cost basis of that September 190 call to 670. So you're at a small loss right now. Value's about $6, let's call it. So you're at a loss of about 70 cents using the numbers I had to use around May 14th at the close. So if no other events are coming out, what I would consider is maybe just to go into June. And look at that. You're going out a couple weeks to June 8th, 14 days, 71.79 cents. There, now you're going to see time decay in 14 days, but just keeping this as a calendar still lowers your cost basis further. You went into high premiums around earnings or around an event coming up for that short-term option. The stock was at 191. The 190 call at the time, yes, it was 14 days out, 11 days out in time, Khokon, but it was highly inflated. You got 470 for it. Of course, you paid 970 to the other one. So now you're only getting 79 cents. But that's not bad. It's a 15% return, but it's not a loss. It's not taking a 70-cent loss. It's not waiting 119 days to hope the stock falls below 185 and then worrying about how you have to manage that bear call. This is 190, some room to grow, 14 days out. Yes, if it continues to fall, we might consider lowering the strike right now. As we talked about with Paul, before you do any management, the idea has to come down to what are your expectations. If you expect the stock to recover, that's good. You had mentioned in your email that it didn't look great. The stock was not that strong. You may want to also protect it short term. Maybe use a short term put if you think it's going to decline, or exit the position and just take that 70-cent loss and look for a new stock that better matches as well. Okay. And that's, as I'm saying it, Sam's commenting in. He says, you could consider buying a 190 put to protect your calls. Sam had a similar trade in Apple. He did a bull put credit spread at 175 and protected it with a 190 put. So, of course, that would have changed the dynamic of the trade, Khokon. And you were doing a horizontal here for the high premium around earnings. Now we see one of the reasons why I honestly up front tell everyone I don't trade the horizontal spreads the horizontal calendar spreads with the tent profit and loss chart, because you get that volatility crush quickly, and that worked well in your favor for the short. But now it puts you in a position where the long also took a big hit from where you paid it at 970. And yes, you took some of that premium against it, but you're still looking at a loss, mostly because of volatility crush. Okay, so based on the stock chart, analyze your position, analyze the structure. You're in a long call right now. You could keep doing it as a calendar, a horizontal, for example, or even a diagonal. I wouldn't sell the 185 below it for the diagonal, because you might get assigned. Okay, you would be selling, calling the money, and you might get assigned, and that's not what you want to have happen at this point, because it would be a loss. That's the key. Okay, and so looking at the structure of the position, we talked about how you said it looked promising and so forth. I'm sorry, the stock chart didn't look promising as you'd hoped. But this is another way to management. I don't know if going out and creating a vertical spread to September is the best idea at this point, because a lot can happen between now and then, and you may overthink yourself trying to manage the positions. All right, let me go back up here. Bob left. He had a long question, and it was later on. He asked me to call him later, but he asked me about 7 positions: ABX, ARCB, Boot, FTFT, MBFIA, so on and so forth. Stock options for June, Friday, all at a loss. What can I do to save my positions? Let's see, I already pay $1,100. Okay, so yeah, I'll take care of that later. I'll probably give him a call or send him an email later. Now, let's get to the other questions. Let me go back. Tom was the first question that came in. It's an interesting question because it's not something I trade personally. And I'll stick with HD since we've been looking at that. I'm just going to create something out of the blue here. So Tom asks, Mike, if I have a conventional butterfly, and I'm assuming you mean an all-call butterfly or an all-put butterfly, how do you adjust one of the wings to convert the trade into a broken wing butterfly? Okay, so HD at 186 right now, or let's say it's at 191 a few days ago. I was going to say May 14th, it was at 191. Let's look it up. I'm going to go to the chain actually for HD. We're going to go back in time using the historical chain very quickly. And I want to go back to May 14th. And it doesn't really matter. We'll use the call butterfly. Not the iron butterfly, we'll use a call butterfly. And then the stock was at 191. Yeah, let's do that. We're going to sell the 2 at 3. Oh, I got to go to the 8th. I apologize. Oh, no, the 25th. I got to go 1 week out, June 1st. I'm very sorry, Tom. June 1st. I got to go to June 1st. The 190s, all right, 410 to 490. Those would be the 2 calls I'd be selling. So midpoint at 450. Let's be generous to ourselves. We're going to sell 2 190s. I'm going to buy a 185 call. Now I'm going to keep it short. I'm going to buy 187.5 for about 620. And we'll do the 192.5 and 320. Okay, so let's build that if I would have opened it on the 14th. So June 1st, still some time left so we can look at management. We did the 2 190s, bought a 187.50, bought a 192. So essentially we've got a bear call credit with a bull call debit, Tom, is what we're looking at here. Oops, sorry, to create this position, the structure. Let's see here. Here we go. Okay, now I got to put in my prices. We're going to get $450, so $9 total here. Was this going to work? I got to cheat. I apologize severely. I have to cheat here. So the 187.51 at 620. Let me just take a look here. I think I botched this in a sense that it wouldn't make much sense to do this. Oh, no, it'd make a lot of sense to do this. Okay, there we go. Yeah, because if the stock's at 190, we get the 250 from the bull call debit spread, so we make it 210. But this wasn't done at a credit. I would have tried to force that to a credit. So let's cheat. Let's put this up to 470, knock this even down to 6, knock this even down to 3. Not realistic, I know, but let's just get that credit on this one. Sometimes they're done in a debit. Let's try to get the credit. Huge return based on the risk. We still have a 250 risk, 250 margin requirement there. All right. Oh, no, that's not realistic either. That'd be a no risk one. Sorry, let me go back to where we were. Apologies all around. Anyway, a broken wing butterfly, Tom, is just a structure that's left. It's not changing any major adjustment on the position. You're actually just rolling one of the longer legs to whichever works out for you best. Okay. Now, in this case, it's gone against you. So creating a broken wing butterfly by selling to close the 187.5 and buying to open the 185 is not going to give you a lot of girth. It's going to increase the risk, actually, I believe. But what does that do? So let's go ahead and do that. Now that the stock's fallen, I'm probably going to lower the other one, but I can't, right? I'd have to raise the other one. But anyway, here we go. If I sell to close this now for a cheap of 75 cents and buy the 185 at the lower strike, this is not, I don't think this is a defensive move that you'd want to do. Yeah, see, so this creates the broken wing butterfly now. What it did is it leaves you open to profit if it comes up here instead of going to a loss, but you've increased the loss to the downside. A broken wing butterfly is simply the same thing that you're doing, but either outside leg, in this case, it would be 5 points away instead of 250. Okay. Yeah, you said you wanted to use the butterfly as the initial setup and then adjust to a broken butterfly to enter the trade. I'm not sure I understand that. But a broken butterfly is just the same thing as a butterfly. And what I might have done is done it this way to begin with, where I have a wider... Shoot, why is that not working right? Oh, it's because of the cost basis, okay. But see here, now you've still got that sort of tent profit and loss chart. You sold 2 at 190, because I took out the wrong one. You have 2 at 190, and then you'd have a 192.5 call, and then a 185. So what I don't understand is you're saying that you would use the butterfly as the initial setup, then to enter the trade as a broken wing butterfly. That only works if the stock moves up. Okay, so in our other example, let me get it back to where we were with the 192.5. If the stock moves up, what I would consider doing now, thank you. If the stock moves up, I might sell to close this call, which is gained in value, and buy a 195, and that might sort of give me that different profit and loss chart that we saw here, where now we have a 5-point spread at the top and still a 2.5 at the bottom. So if it does cut back down, we might be in this profitable range. It might be better just to open the broken wing butterfly if that matches your goals up front or close to it to start with. But again, yes, you can create the broken wing butterfly just as you can roll the outside leg in a condor if you want to. But I don't know if it's going to give you what you want. Okay. I chuckled only because I looked at the next question. And everyone has their own opinion. And I had a conversation with a gentleman about this the other day, about stock selection and stock criteria and more. And let me write down what that was. Feel free if you have any follow-up questions, of course, there about the broken wing butterfly, Tom, let me know. But yeah, it is a management technique to use, but you can only do it after a move. If the stock moves down on a butterfly, what I typically would consider doing is buying to close one of the short legs at a profit and selling something lower to get more premium. And if it goes up, I may consider rolling this, or I might actually roll both. I may roll one of the 190 calls that were at the money and the 192.5 and open it up to maybe 192.5, 195 on that side. Okay. JD says, What criteria should you use to give up? Oh, I did read it wrong. To give up on a married put besides maybe under 200 day for several weeks. All right. In the blueprint, there's a full chapter there on exiting the RPMs inside the blueprint. I think it comes after the combining the income methods chapter, after it goes through the 11, 12 income methods, and then the combining income methods chapter. But I think this whole chapter on exiting the RPM is right after that. But anyway, in there it talks about, oh, there we go. It talks about what we would look for in these scenarios. Okay. My first check. When I open a married put position, not AMD, when I open a married put position, here is, let me just stay here for a moment. Oh, sorry. Let me stay here for a moment. Canada Goose, we opened 24 days ago. Bought the stock at 36.18, bought the October 40 put for 6.40. When I open a married, oh, this is extensive. Let me not look at it. This one's doing exactly what I want. Okay, that's up 9% in the first 24 days. Interactive Brokers is up 15% in 90 days, but it was up exactly what I wanted. When I open a married put, I'm looking for a position, JD, as you mentioned, to move up 3 to 6% in the first 30 to 60 days. I've been in Polte for 45 days. It's only 1.5% up. It's treading water. We bought this on April 10th, okay, at 30.02 was the original position, 30.02 PHM. And let's go back 1 month. Let's go back 2 months. Okay. So on or around April 10th, we got in here at this little dip. No, we got in just before the little dip at 30.02. Naturally, since I bought it on April 10th, it pulled back. That's just what's going to happen. But anyway, so you see it drop down, and then it had a big hit. But then it was back up to 31.50. So within, again, that first 20 to 40 days, it was doing exactly what I wanted to, and it stabilized. And then this was not earnings related. It just plumped. This is more related to the interest rate. This was the interest rate discussion, PHM, Polte Group, home builder. So it plummeted, okay? But then it's been moving back up. So 20, 30 days is my first checkpoint. If the stock's not doing what I want in the first 20 days, I have to make a decision. So if I had bought Polte, PHM at 30.02, and in that first 20 to 30 days, which is roughly here, when it did have a dip, but remember, I was doing exactly what I expected. But if it hadn't moved beyond 30, I'd have to make a decision. What are my two or three decisions? Number one, check out what's going on with earnings or ex-dividend. If anything is coming up in the next 2 to 3 weeks, I might as well stay in it, right? Get that dividend, maybe go through earnings, get a little pop. So number one, what's coming up in the next 20 to 30 days? Probably only 20 days. What's up next? Okay, that's the first thing I want to consider. If nothing is coming up next and it's still stagnating, number two, I might have rolled that October put into, same strike, 31 strike, but I might have moved the October put into August, probably July if it was available. What does that do? Remember, yes, I paid 302 for that put. I would have lost time premium, but the nearer term put, the July or the June put that's only 45, 50, 60 days away, would have been much lower. So I could have lowered my cost basis by $1, $1.50 by keeping the same 31 insurance, but moving the put closer in time. Yes, I lost a little bit on that original put to time value decay, but I could still lower the cost base. So I have to consider rolling the put in. And if I roll the put in, I'm still going to check earnings. So if I see that earnings are on June 30th, I'm not going to roll to the June put. I'm going to roll to the July, so I still cross that earnings. Number three, exit. Discussion I had with Greg Zerenner, Vice President Ernie's son yesterday. We were talking about maybe it's better just to exit some of these positions, not just married puts, but exit the positions when you're in the first, quarter cycle or the first 25% of the trade, and it's not really doing what you want. It's not moving the direction you want, or it's giving you bad sales. Maybe just exit, get out, because there's so many opportunities that we see. Well, how, we get calls and emails every day. How could I have caught this stock? How could I have caught Foot Locker? How could I have caught this around earnings? So you had to take a gamble. As simple as that. for the earnings plays. But there are other positions that have been moving up lower left to upper right in the past 2 to 3 weeks with some smaller hiccups in it. Okay, so there are stocks that are moving. So maybe I just take that exit, JD, move on to the next one. Look for a better opportunity. Okay, why haven't I done anything with PHM yet? To be honest with you, one thing I should have done is rolled from the 31 to the 32 put up here and taken my risk down to about 3% total. I might have also sold the 32 call for a little bit, taken my risk down to 2.8. But I was afraid if there was a pullback, I'd be stuck. I was waiting for it to go above 32, to tell you the truth. That was my target. But I was afraid that if it did pull back and I was holding the 32, it'd be much harder for me to adjust the position. So as I was about to adjust it here, it started to come back for us, and now we're approaching that 31 range again. I showed it earlier, what would happen if I did a collar on PHM, and I didn't like it. Okay, the going 14 days out, 20 days out, I did not like it. It wasn't a good risk-reward trade-off. So I'm not selling the call on PHM right now. Earnings are coming up, I believe, in early July, late June, so I've got some time, and it does offer weeklies. I'm going to do an adjustment. We'll see what happens in the next couple of days here as we go forward. There is such a thing, I'd warned Paul about it, about over trading. That's what I not want to do with this position. So I'm over 40 days in, and the stock's pretty much just a little bit above where I got in. Why haven't I closed it yet, JD? This is where I was going with this. Because it did do what I expected, but hit something outside. While the stock's still showing growth and positive earnings, I still believe it's bullish. But the housing market sector is a question mark now with the interest rates, and we've seen some weak housing company profits where others were strong. PHM was strong on their last report. Others have been weak. So it's a concern. So I've got to take that into account. But essentially it is doing what I want, even though if you look at it just, oh, well, I got in here and exactly 30 days later, it's exactly where it was when I bought it, I should continue exiting. Well, I got to remember that it did do what I wanted during that time frame. And it's recovering back from the pullback it had. So I'm at a point now, what did I do? I gave myself another 15 to 20 days from about here. Okay, so on or about 1st of June, if the stock's still wavering in this 30-50 area, I'm probably going to roll the put in closer in time, cut down some of that risk, keep it open through earnings to see if I get any type of pop while maybe trying to generate some short-term premium against it. But I may by June 1st, if it does this down to 29 again and comes back to 30 and down to 29.50, I might just get out of it because I know there are more stocks that are doing more what I want going forward. Okay. The moving averages are a good trend. If I see the MACD, I always get into the position when the MACD has that positive crossover and when I'm above the 20-day moving average. Other stops or warning signs I use, JD, is if the stock drops below the 20-day moving average, because that's one of the filters for the married puts, or my MACD goes to a negative crossover, which it did here. But remember, I was coming off of it doing exactly what I wanted in the first 20 to 40 days for that structure. So I'm keeping PHM open for right now in that structure. Okay. All right. All right. So, okay, just in there. All right. Sam had said, of going back there a minute ago, Sam said, what about the butterfly? Is it a bullish or bearish strategy? When do you trade? It is completely neutral. It's the most neutral thing that you can do. Iron butterflies, all call butterflies, are all put, as we saw with that very strict tent profit and loss chart, Sam. They do offer a high return, but not a great wide open upper to lower break even. Okay, so it's a very neutral trade, though. You're not expecting the stock to move more than plus or minus 2 or 3% for the time that you're in the trade. And if you're doing weeklies, it's more like plus or minus 1%. You don't want the stock to move more than that. It's the most neutral thing you can do, which is why I don't trade the butterflies personally, or even the broken wing butterflies, because the idea there, let's just go back to here. Let me clean up the drawings, not cut up, clean up the drawings. And this is like a fantastic return, but it's predicated on the stock trading right at 191, the short option strike price, where you sell 2 calls and buy the outer wing calls. Or if the iron butterfly, Sam, is taking a bear call credit and a bull put credit for double credits, but the short option of the call and put are at the same strike price. So this would have been my bear call spread, selling the 191 call, this would have been my bull put, selling the 191 put and buying the 187.5. I'm sorry, the 190. Sam, I apologize. And yeah, this isn't for you, Sam. I know that based on our conversations, but the reason I always tell every investor why I don't trade these positions, it has a great looking return. The upper and lower break evens are not that wide, although they're pretty good. They're not as wide as you can get with an iron condor, which would have a shorter return going out of the money. Okay, it's really like an iron. You can set this up sort of like a condor, but the condor is using out of the money short options instead of at the money, and they're the same. That gives you that 10. Higher return, but even with that higher return, you have a lower upper and lower break even. And this, I have been successful 67, 68% of the time picking stocks that do what I want in the first 20 to 30 days. I do not have enough skill, and I will gladly say it without shame. I don't have enough skill to consistently pick when the stock's going to be trading at a strike price or within 1% upper, 1% above, or 1% below within 14, 7, 15, 21 days. I don't have that talent. If you can do this consistently, if you can pick where stocks are likely going to be trading plus or minus 1% on a consistent basis, whether you're looking 14, 21, 31 days out in time, and by consistent, I mean 70% of the time, 68, 70% of the time, maybe even 74, 75% of the time, then this strategy will work for you. And if you can do that, target where stocks are going to be trading within plus or minus 1%, 14 days, 21 days out in time to set up your structure 75% of the time. As you've probably guessed, you don't need to be here on these webinars. There's nothing I can help you with because you're probably doing a lot better than I am with my strategies and my positions, because that's not something that I can do and don't have the skills to do. And if you can do it, you're ahead of most of us. But that's why I don't trade the butterflies, because this structure doesn't agree with me. I like going with the trends, as Sam had mentioned. He likes going with the trends as well. All right, Wes, you are next. Wes and Mark. Okay. Oh, okay. Okay. So I don't know if we're going to be able to go in depth into this, Wes, but I can talk about it with you and I can point you in some good directions if you haven't already done that yet. Wes is talking, he says he'd like to have coaching on buying a leap option on SPY to protect my overall portfolio for the next 6 months. Okay. He uses Thinkorswim, but he's not confident to make this trade. Okay. I don't have the slides available I can grab, but let's talk about it. There's a long call. I'm going to go to long call for a moment. There's a couple things you have to ask yourself or write down for yourself first, Wes. Okay. The first thing is, what is your fear of the SPY anytime over the next 6 months? Is it that the market as a whole could drop 10% as we saw from February 5th to February 9th? Maybe it'll drop about 7% as we saw from March 20th to April 5th. Okay. And then take something into account on that. Take into account, what do you think your portfolio would look like if the SPY dropped 10%? Meaning, how much would you lose monetarily in your portfolio doing nothing else if sometime within the next 3 or 4 months the SPY dropped 10%? You could assume your stocks dropped 10%, but one of the things we can look at, let's take HD for example. I'm going to go to the quotes page here, Wes. So I'll type in HD, I'll go to quotes. This takes me to the stock page. And it used to be there, now it's not. Someone moved it. One of the programmers moved it for me. There it is, beta. All right, so the beta of HD is 1.07, meaning it sort of tracks the S&P 500 pretty closely. Beta of 1 means almost 1-to-1 volatility movements and shifts against the SPY, the S&P 500. Okay, how the stock reacts to the S&P 500. That's the beta. So this is pretty much close to a 1-to-1 ratio. Now, if this was at 1.2, and I'm assuming a 10% decline in SPY, I might figure that my stock might lose 12 to 13%, not the 10. All right, so that's how I'm using the beta in a sense. If my beta was 0.8, I'd assume that maybe I'd only lose 7 or 8% if the SPY fell 200. I'm sorry, if SPY fell 10%, my apologies. Okay, Now, so once I've got that in mind, you can use the beta to do that. You can just assume, look, if SPY falls 10%, all my stocks would fall 10%. Okay, what would that overall effect be to my portfolio? How much would my portfolio decline in that situation? Monetarily and percentage, Wes. And then I want to decide something else. Then I want to decide how much of that do I want to protect. If a 10% decline in SPY, I'd assume that I'd lose 10% of my total portfolio, then I need to find something that's going to gain 5, 10, 15%, or gain half of that monetary loss back in the case that SPY drops 10%. How can I do that? Okay, well, we've got a tool here. This might confuse you, Wes. I'm going to access it through the long call. Actually, I'm going to go to the Signature Tools tab. Okay, 272.15. I didn't get the final price before we started the webinar today. 272.15 is SPY right now. 10% drop, $27 down. So we're going to be below, we're going to be at 245, right? 27 down, yeah, 52, yeah, 245, okay? So I'm going to go to Signature Tools, but I can also access this from the long call or the long put tab. We're going to go to Long Option Finder. And I'm going to put in SPY. Now you said in the next 6 months, you're going to buy a put 6 months out, but you're not expecting it to happen at the end of the 6-month cycle. You're thinking somewhere in between. So we put in SPY. Expected price 245, or $27 down. Investment amount, let's make it big for a minute. Let's put in just for now 3,500. I know that's not huge, I know, but let me just put that in there for now. An expected date, let's go out 2 months. Let's go out 3 months. Let's go out to August 10th. Okay, so this happens about 3 months in, on or around August 10th. I know it's less than 3 months, but let's say that happens. We see the position drop. What does this tool do for me? Well, if we weren't loading all of, there we go. What this tool did in that instant, Wes, is it went out and looked at every available put option on SPY. And what it calculated for me is which option, which put would give me the highest percentage return. Now, these are all close because that's a pretty big drop for SPY. But which option would give me, put option, of course, would give me the best return if the stock did fall 10% on around 2 or 3, 2.5, 3 months in. And we see we've got the August 263 put, 84 days out. Okay. And we could buy 10 contracts at 342. And if the stock fell to 245, these be worth about $18. That makes sense, doesn't it? It's right about intrinsic value, so it'd be a 424% return. Okay, now does this mean you should buy 10 contracts? No. What I'm showing you here, what this tool gives you, this is usually for profiting, just buying long calls and long puts, but if you factor in those other equations, right, you're going to put $3,500 into insurance, this is going to give you $17,000 back. So let's say you had a $100,000 account. And your expectation of a 10% drop in SPY on your stocks means you'd lose 10%. Let's keep the math simple. So that's $90K. Okay, you've lost $10,000. You're down to $90K. You want to hedge. You're not going to be able to hedge all of that loss, right? You're still going to take some loss. But what this helps you to see is, look, if you put in 3,000 and your position value is worth 17,000. That means that you could potentially make $14,000. That does hedge that with the 10 contracts, doesn't it? Okay, I'm not saying it would turn you to a profit, but you could actually buy 7 contracts and have a lower cost basis of around 22, 23, and then this wouldn't be as high, but it would counter most of this loss. But see, that's the idea. Now, why am I focusing on setting up the ratio in that sense? Because remember, what's the worst thing that can happen? You spend $3,500, $3,600 on insurance, and the market stagnates and never hits the drop you expected. So you didn't lose the 10 grand, but this is going to zero. You did lose 3% or $3,600 because of the cost of insurance, right? So I want to keep this as low as possible while still protecting my worst case scenario. All right, all of that being said, Wes, what you need to do now, because I don't have the time to walk the math through you, but I have it written out for you. If you haven't done so already, go to the home page when you log onto your account and click on blog, or just go to blog.poweropt.com. Okay, let me send that to the chat window and everyone. A while ago, and we followed that up later on, but a while ago, as you scroll back here, there's some articles. We have the market parameters. Here it is, part 1 and part 2 of stock or portfolio insurance. In part 1, we talk about the ways that you can hedge a portfolio. Here's a link to the video that describes exactly, well, if I expect a decrease, how can I protect my portfolio against an X decline? And the clarifying point needed is how much of that X decline do you want to protect? If you wanted to hedge 50% of the decline, we want to choose a put option that has a delta of 50. But this is a full webinar there on how you might look to protect if you're expecting a decline in the market. What put might you look for using that tool to help you, using that long option finder to help you, and what ratios you might need to look for in that scenario to do that. There's other things that are discussed here, and we've discussed them on the weekly webinars. I wasn't going that deep into it, Sam, for Wes, but there are other things that we can do. I could buy calls on VIX. The VIX calls for a volatility spike. If the market does fall, volatility is going to jump. I can buy cheap VIX calls. VXX calls. Sam also likes to trade UVXY, which is a volatility sort of ETF as well. And so those are things that you might want to consider, and you'll see about that here. So go to blog.poweropt.com. You might want to start even before this one. Let's go to part 1, stock or portfolio insurance, and then part 2 of stock or portfolio insurance. That's some homework for you over the weekend. And in addition to that, on the webinars page, this is also the public page, poweropt.com/webinars.asp. Okay. We referenced this once or twice during the webinar. I promised you I was going to cut some of this out and then do smaller presentations with some of the more encouraging ones. And there we go. Okay, but I left these here. So on this view, Wes, on this view here, poweropt.com, /webinars.asp, you see the 4 topics at the top. Power options, tools, strategies, concepts, and requested topics. This is the archive of our Friday discussions. From January 22nd, no, I lied. January 30th, stock insurance and protection discussion. So there's a discussion there on it. But more importantly is the later one on 2/27, portfolio insurance, managing a declining stock. But that first part there is insuring a spread portfolio. More ideas, similar ideas of what we talked about, with delving into a little bit on that VIX discussion and more. Okay, so that's where you're going. Then as soon as you have any questions, Wes, you just give me a call, send me an email, let me know. But the starting point is take a look at the blog. Just go to poweropt.com and click on the blog, blog.poweropt.com, and look at that part 1 and part 2 of stock or portfolio insurance. Then you can go to the webinars page, go to requested topics, and there's one from January 22nd. I'm sorry, January 30th. Probably more importantly, though, is the other one I mentioned. How did I just lose it? Oh, the 2/27. I'm sorry, guys. Portfolio insurance, ladies and gentlemen. I'm sorry. Portfolio insurance. There you go. Okay. All right. All right. So I'm sorry, Mark covered this a little bit last week. He says, not a question, more of a comment. It is interesting how malleable that calendars are. The long can be in the money, out of the money. Short could be in the money and out of the money. And of course, there's consequences. Unremarked by most people putting thoughts into text. You'll have to work that out for themselves. Well, it's based on direction. It's based on your market sentiment is what you want to do. Okay. Let's go back to HD real quick on the custom spread tool. And you're right. It's amazing how flexible you can be with calendars, but you also have to make sure you're not being flexible for the sake of having something to do. I like to do my standard diagonals, which some refer to as the poor man's covered call, and I've said ad nauseum to you, everyone in the room, and those of you who've been with us before, that I hate that term for a diagonal spread because it dumbs it down. I'm not buying a leap call that's so deep in the money that it has a delta of 1, so I'm mimicking stock ownership. I mean, even on HD, I'd have to be going to 120 or 110 to get a delta above 0.95, right? I'm not doing that. I'm buying a few strikes in the money. Stock's at 186. I'm going to buy a 170 call for September. And it doesn't have to be September. I can only go 2 months out. I could go to January. It doesn't have to be a leap. And then I'm going to sell 14 days against it with our... I shows out of the money. I'm going to do the 187.50. Okay, so I'm going to buy the September 170 is in the money and sell the 187.50. Okay, now this gives me the profit and loss chart that I want, not the return that I want. I'm looking for double digits if I did this, even with 2 weeks out. I'm going to want to be 12, 15, 20%. There we go. That's a little bit too short for me with a stock at 186.85, but that's okay. There's your diagonal setup. Okay, now a lot of this is buying in the money. I'm paying a huge debit to do this. Okay, and some investors say, well, you know, I like the other diagonals where I'm selling here because I think this stock's going to be at or below it, but to protect myself, I'm going to go further out and buy something that's higher. So I don't have $1,700 per contract. I'm going to take this out and I'm going to buy a September 195. Okay, and this is what we were referring to. It could be the one you buy could be in the money, which I prefer, or it could be out of the money. Right, so I'm only paying 403. This return looks phenomenal, but remember, this is actually bearish now. The benefit of this position is the stock staying the same or falling. The benefit of the initial structure I created is if it's neutral to bullish. And if you think the stock's going to be stable or falling, why not just do a bear call credit spread to begin with? Or a diagonal put. See, if I did a diagonal put where I bought the September 195 and sold the September 187.5 put, that's a parity trade. I have the exact same risk reward profile with a higher cost, of course. So it's interesting, but remember, changing the structure also changes the dynamic of the trade. So you want to make sure, not say, oh, well, yeah, I see this is bearish, but I thought the stock was going to be in this range anyway, so this is still a good trade. Well, compare that to the other trades you might open and say, what gives me the best bang for the buck if, yeah, I'm in this range? Maybe it's not a calendar. Maybe it's something completely different. Or maybe it is a calendar. Maybe it is this calendar. Or maybe it's buying the 180 and selling the 187.5, so you don't have an upper and lower break even because the strikes are closer. You still make the profit here, but if it goes up, you don't have 2 ways to lose. That's another way I don't like my calendars. I don't like to structure the calendars where I have 2 ways to lose. Okay? So there's some thoughts on that. Yeah, they're beneficial. What do you change? Well, you're going to change 2 things. You're going to change the cost. You can get a lower debit for a diagonal, but that's going to change the direction. You're going to get a higher potential percentage return because of the lower cost, but the monetary return might not be as high by using an out-of-the-money long instead of an in-the-money long. And here you might structure yourself for 2 ways to lose. That's based on how I did it, not to say you could develop ones that don't have 2 ways to lose and where this line stays above here instead of dipping back down into the loss area for this diagonal. But again, I want that structure that looks more like this if I'm neutral to bullish. If I'm neutral to bearish, I look at the diagonal calendar puts because I can get that similar structure as well. But they are flexible, they are malleable, and even in the case we talked about with HD, with that 190 to 190, as we're still sitting on that September 190, I could sell 187.5 and create a bearish calendar as a repair. That's something else you can do. But if it snaps back, now I have to remember that my risk is in the upside, which is the original direction I thought that the stock was going to go. Okay. All right, let's see here. One comment I don't think I mentioned from Sam, but during the discussion with Paul about the collars, Sam offers that you might want to look more into bull puts or bear calls. And Paul and I have talked about that before. Even structured properly, we prefer the risk the risk reward of using the collars to only be risking 3 or 4%, even though we're only making 2%. Now, you could always structure it to make sure that if you do take a full loss on the credit or debit spread, that you're only risking 2 to 3% of your total portfolio. But Paul is trying to maximize his structure, looking for the best, not the best per se, but looking for his goals for that 1-to-1 risk-reward ratio attempt we saw. But it does run the risk of falling potentially into picking stocks that have too small of a premium, which really makes the adjustments harder because you're fighting nickels and dimes in midpoint and bid-ask spreads in 7 to 10-day trades. So it is important for Paul. And that's something I didn't mention in the first part of our discussion on the collars. Paul, it is important for you to maximize that return because you're fighting these nickels and dimes with these lower premiums. But my fear is still that by wanting to trade too much to maximize that return, you might actually be handicapping yourself with the commission costs and the rolling and adjusting too soon and paying too much to do those rolls and adjustments and not getting enough bang for your buck back on the strategy. It might just be better to let some of them go and get assigned rather than worried about it. Good call, Sam. Sam says he bought 20 calls on UVXY recently. Let me just go there. UVXY, I'll show everyone what it is. We talked about these volatility indexes and ETFs, and this is the VIX Ultra Short Term ETF. Don't worry about the phrasing there. But you bought 20 calls because SPY is not breaking the 275 resistance areas, and you feel it's about to drop 2 to 5%. And that's why I picked up calls earlier this week on the VIX, the Straight Volatility Index. One of these days, I'm just going to do UVXY, Sam, so we can have the same discussion on this. But yeah, I bought the VIX calls, which are already profitable, earlier this week when it was down below 12. Was it down below 12, or was it, what am I thinking of here? Was that last week? When did it dip? It wasn't there. Man, let me take a look at the VIX. It must have been, I must be thinking of 13. Sorry, brain's not working. It was those days when it was down to 12. Yeah, that's what it was. I apologize. It wasn't below 12. It was when it went below 13 earlier this week. Yeah, that's where it was. Yep. Yeah, it was Tuesday and Wednesday. Into Wednesday. It was Wednesday. I bought calls on the VIX out in time. Okay, so, oh, I'm sorry, yeah, and then you were talking about, Market commented back in, and yes, he said, if you go into the free webinars, I'm sorry, in addition to what we talked about with the calendars, if you go to the option strategies, we have that calendar spread criteria and the calendar spread basics. That's what he's alluding to, that I had referenced it there before during those webinars about how dynamic they can be, about the calendars and the diagonals and so forth, and they can be. And Sam, another comment is he had mentioned he's doing calendar puts on IWM. That is interesting. I hadn't thought about doing that. I haven't done a calendar put in a while, and I should be doing one on SPY or IWM, QQQ. So I'll be looking for that too. That's something I should have considered. My calendar has actually worked out well today, or this week, going into expiration. Going back to the discussion we had for Khokon, I'm sorry, with a diagonal, I have a diagonal call spread that was coming to expiration. The short option was coming to expiration this week, and it did exactly what I wanted to, and it exceeded it. There it is. It's this one here on VMC, and I bought the 120 call for June 15th, and I had sold the May 25th 130 call against it at a good premium. Oh no, I'm sorry. It was the 115. I bought the 115 call, and I think I sold the 130 call for this week, 25th expiration. During this week, the stock went up to 128, 129. This call was still going worthless, only 5 to 10 cents to buy back. So what I did, let's look at the analysis real quick. VMC, there it is. Oh, it was the 115 call I bought. And, oh, I'm sorry, it was 18th of May. It was last week's. The 130. call for 165, but the stock moved up. So what I did is I bought to let this expire on May 18th, but bought it back for 5 or 10 cents. But the long call had gained 297 to 42.90. So I rolled this up from the June 115 to the June 120 and sold the June 15th, as we saw, 130. So I converted my calendar into a bull call spread. As Khokon had mentioned, to be in, that's not the right, yeah, to increase the profit and to lower the risk by half. So instead of originally when I had a risk of about 1,800, I put the max profit up to 2,100 and lowered the maximum risk to only 800. Now it's still at 127, it's still floating around, but that's better than a 1-to-1 ratio. So I did convert the calendar into a bull call debit spread. But of course, that's when the stock was at 129. It's since pulled back to 127. So now I'm debating what to do. But I rolled the call up to take the cost out, and that cut the risk in half. And I was very happy with this so far. I could probably roll the call again. I'm just not sure if I want to. And if I did roll the call again, this would lower, but I'd probably cancel all the risk and be in a no-risk bull call debit spread through June 15th. But I still could make nothing. Right? The no risk meaning it'd be a bulletproof spread at 125, 130 with no risk here and a small profit of maybe $20. But if it fell below 125, I'm only making $20. It'd be better exiting right now. But I think it's still going to go up based on what it's done. But that's when it goes up, you can convert the calendar into a bull call debit. You might cancel half, if not all of the risk, depending on the scenario as well. All right, so let's see here. And again, Bob had left his comments and left his phone number, so I'll get back with him either this weekend or later on. You have a caller in Twitter. Okay, we're looking at that. Oh, Sam says he's got to take off. So he thanks everyone in the room there for the discussion. We're going. Okay, so Mark had another comment come in here I want to take a look at. He said, one of this trader's educational efforts are related to call or put diagonal calendars. Not one web source has much to say about this. It's the terminology, I think. Yeah. The diagonals, there's a lot of terms that have been thrown out there, and some people create the double diagonals, Mark, which I don't do. It's sort of mimicking an iron condor, but with more time on the side, meaning that I sort of create a tent profit and loss chart, and a lot of people started to get really into the double diagonals. And this was about 4 or 5 years ago. And to tell you the truth, just like iron condors, double diagonals weren't really that successful, even with all the management techniques. Now you get really confused. You open a double diagonal and you say, oh, well, you can convert the double diagonal to this broken wing butterfly, and you can do this and you can do that if it moves up or if it moves down. Well, the problem is that over the last 2 years, up until February of 2018, everything was lower left to upper right. You're better just being in a call diagonal spread, the poor man's covered call. Someone's teaching it as that. They don't even call it a diagonal. They call it the poor man's covered call, which bothers me because it simplifies it, and you really have to pay attention that you're not mimicking stock ownership. You have two working options that are gaining and losing as the stock fluctuates in price, and it's always important to remember. It's a good way to get people who are used to covered calls into it, teach them leverage. What I found is a lot of people that do that, when they teach the leverage diagonal call spread of using that leap option that's in the money, they don't inform the students that if the stock falls 10%, you can lose 30 to 40% on the leap option, because leverage works both ways. They're getting them in by the idea of making 20% by doing a diagonal spread instead of 3% on a covered call. They don't talk about that you can lose easily 30 to 40% of what you invested in the position because of leverage the other direction. 186.85. Double diagonal I might do would be selling a 190 call 1 or 2 weeks out. And as we talked before, I might buy that September 195 or 200. Let me use 10 points. And at the same time, I might sell the 180 put, not the way I do it normally. I mean, this is not the way I trade it, and then buy the 170. So what does this do for us? We're selling an out of the money call and an out-of-the-money put and buying outside wings. It looks very similar to an iron condor, but with time. All right, so the idea is you can keep selling it and selling it. Let these expire. If it stays between 190 and 180, that's probably too tight of a window, but let those expire, and then you've already got the longs out there. You've already paid for them, so then just do another 190, 180 for the next 2 weeks after these expire, and so on and so forth to keep lowering this cost basis down and keep increasing the profits. But think about it, over the last 2 years, the market was lower left to upper right up until January 2018, and then we've had this fluctuation since February 1st. This was a terrible time to really be in iron condors or these double diagonals. And I think what you came across when you mentioned that searching around the internet, Mark, no one's really saying diagonal calls or diagonal puts, is because they're probably looking more at these double diagonal spreads because they're more attractive. But I just think the last 2 years I probably did better with my diagonal call spreads than I would have with the double diagonals because the market was lower left to upper right. And investors tell me that, yeah, you can profit, you can do iron condors, you just have to set the call farther apart if you think it's still a bullish time. I know that. I know it can go 4% out of the money with my bull put spread of an iron condor and then go 8% out of the money with my bear call credit to create the iron condor. But why not just get a better, so now the premium is really low over here, why not just get a better premium if I'm this expectation and do one bull put spread that's 4% out of the money and do another bull put spread that's 4% out of the money? Oh, sorry folks. Why not do it that way? Well, because of February 5th to February 9th and March 20th to April 5th. Okay, that's the reason why. All right. Well, I don't see any other questions that have come in, ladies and gentlemen. If anyone has a last-minute question, you can send it to us. Sam wishes everyone a great weekend, and he says he hopes the weather is nice for everyone. Bob, as I mentioned, had to take off. I didn't get a chance to answer his question before we got to it. I just want to remind everyone, of course, today's material are my thoughts on questions designed for educational purposes, increasing of investment knowledge and performance as well. Any stocks or options discussed should not be taken as direct trading suggestions or recommendations or things that I might be trading next week at all for illustration purposes. As we've always seen, Mike forgets to update his slides, but as we've always seen, options do involve risk. Okay, leverage positions are great. I like to look at bull put credit spreads. I like the calendar spreads, but leverage works both ways, and you have to pay attention to that. Proper position sizing is essential because options do involve risk, may not be suitable for all investors. Markets will be closed on Monday. Just a reminder, everyone, of course, Memorial Day weekend markets will be closed on Monday as well. All right, so for those of you who have not taken your 14-day free trial to Power Options, just remember at any time, you can go to powerop.com, put in your first name, last name, and email address. We'll get you started with that 14-day free trial. No billing information is required at all. Full use of the site for 14 days. After that, our subscription levels start at $40 per month. Most popular subscription level is $60 per month, the 20-minute delay. But those of you that are doing weekly spreads, weekly bull puts, 3-day out, 5-day out bull puts, bear calls, I strongly encourage you to go to the real-time service. It is $120 per month, but I encourage that because it really helps with the management and the adjustings. It's almost essential for those types of short-term trades. As we saw today, we referenced it before. You can get a lot of our other free information at any time by just going to the blog, blog.powerop.com. We, of course, referenced our webinars today on the calendars and others. You can go to powerop.com/webinars.asp. You can always check us out on YouTube as well. As always, today's presentation was recorded from when we started the discussion of the questions via email. I'll get that posted this weekend and have it ready for everyone to watch live, maybe tomorrow or sometime this weekend, tomorrow or Sunday. If you do think of any questions later on, you can send me an email to support@powerop.com or support@radioactivetrading.com. Remember, you can also call the office during market hours, 302-992-7971. And of course, those of you that are trial members or subscribers, you can schedule a coaching session at any time. Underneath the home tab of your account, click on free coaching, and you can pick a time that works for you. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Ladies and gentlemen, thank you again for joining me. Thank you again for your questions. I hope you all have a fantastic weekend. I look forward to hopefully seeing you next week on some of our other live presentations. Take care, everyone. Good night.